Welcome to Villanova University and the Villanova University School of Business presentation on the CQA Investment Challenge. Today we'll be covering our investment team, investment philosophy and process, risk and return expectations, and portfolio performance and attribution of returns. This is our investment team. It is comprised of myself, Connor Worry, a senior here at the Villanova School of Business. I'm majoring in finance and minoring in accounting.
Myself, Drew Petrie. I'm a Villanova School of Business class of 2019 finance major.
Also, Rohan Das, double major in finance and economics, and also a senior here at Villanova School of Business. Unfortunately, Adam Kozik could not be here due to extenuating circumstances, but he is a finance and accounting double major.
Next, we'll be moving on to our investment philosophy and the process we went through when selecting our picks.
Value investing was chosen as our preferred approach due to its long and tried and true historical track record. Value investing goes back to 1934 when Ben Graham published security analysis, and some of its most famous proponents include Warren Buffett and some modern-day successes such as Seth Klarman, Joel Greenblatt, Guy Spear, and many others. So the root of value investing philosophy rests on determining the underlying value of a company and trying to pay less for it. So essentially getting $1 for 50 cents. Margin of safety is the key risk-adjusting control mechanism where whatever you calculate as your underlying value for your business, you must take a discount to account for any analytical or bad luck that might have hit the analyst. So it's a process that requires a bottom-up procedure where you have to evaluate investments as they come and individual businesses and not go by macro themes. So it's very stock specific, and econ is considered at the end of such an analysis. So our take on the classic value philosophy is a riff off of Warren Buffett, who is very famous for his 21% annualized returns. Instead of taking huge margin of safeties on maybe poor performing companies, we try to isolate great players in their industries and pay up just a little bit to account for that growth. We believe that growth and value can really coexist together.
Our security selection process was to select securities that had PE ratios below the S&P 500 average, along with securities with P to B ratios below the S&P 500 average as well, to promote our value investing for our longs, which goes with our bottom-up approach. And with our short positions, we focused on negative momentum heading into earnings.
We also wanted to make sure to select securities just ahead of earnings, just in case we wanted to squeeze out any value from quick price movements just after earnings calls. On the left-hand side of our screen here, you can see our top holdings include Advanced Auto Parts, ConocoPhillips, and Dollar Tree, just to name a few. Their weights exceeded the 5% that we started at with all of our picks. As they picked up momentum in the markets and other picks fell, they began to take over more weight in our portfolio, and they even included the reason for more of our risk in the portfolio as the competition moved on. We started out with 5% as we thought that it was a great idea given our bottoms-up value analysis. We think that starting at 5%, which is the max weight for one pick, would give us the biggest bang for each position in case it were to skyrocket or fall in the case of our short picks. On the right-hand side, you can see our sector weights. The longs primarily sat in the materials, information technology, healthcare, and energy spaces, while most of our shorts sat in industrials, consumer staples, and consumer discretionary. We see that we were either very right or very wrong in terms of our percent increases. We were above 10% for the most part on our long side, while we were above 10% almost in every sector besides industrials on the short side as well. So while we made picks on value, we may not have gotten the right value picks on the short side, because when it comes to value, it's tough to apply the same analysis on the short end than it is on the long end. Next, we're going to be moving on to risk and return expectations. In terms of risk profile, you can see a lot of our risk was active specific risk, the high active standard deviation at 6.85%, and we can see that's composed of specific active risk, which as an active percent of variation accounts for 67.39%, and factor active risk, which as a percent of variation is 32.61%. Below that, you can see that that's composed of style as a percent of active variation at 2.53%, and industry accounts for the highest percentage at 23.68%, with market somewhere closer to the 2.53% at 6.87%. In terms of return outlook, we experienced a high return as of the composition of these reports. In late January, we had a total return of 1.97%. This was from November 20th onward, with a high risk percentage at 7.54%. If we were to redo this competition, we would obviously lower the risk percentage, get somewhere down closer to the benchmark, and make sure that the active risk was a lower percentage of total risk as well.
As you can see by looking at our graph on the left, our greatest risk factor was stock specific.
It makes sense that stock specific return was negative, as we were taking a bottom-up approach that really isolated stock specific characteristics that were idiosyncratic to each of our picks. Now, in an ideal world, it would be positive and our stock picking skills would have shown through, but as you can see, our idiosyncratic stock picking abilities did not come through, and if we were going to go back and do this, we would probably pay more attention to the diligence process and the screening process.
In addition, the market contributed to most of our active return, with the industry coming in second, and this makes sense because the market, we were a little over on our longs and our shorts, which is why we had some returns.
Next, we're going to move on to our portfolio performance as a whole and what we attributed most of the performance to. We're experiencing some current woes in the market, and as such, our portfolio has dropped to a cumulative return of 2.15%. We dropped from 12th place in the competition to 37th place. As such, we have found out that our portfolio did not do well on the short side of protecting us from this downturn. Our portfolio seems to be somewhat not market neutral, and if we were to do this again, we would have to factor in more important criteria when selecting these picks and making sure that we are market neutral and prepared to take on some downside risk if the markets were to turn down. As far as attribution, what we think is going on in the markets is attributed to rising interest rates coupled with signals of growing inflation in Europe, which has caused a lot of investors to shuffle their portfolios around, a lot of them jumping into fixed income products and trying to capture rising rates in European countries, and even moving some of their funds to the United States, but in various other vehicles, as to depart from the inflationary environment in Europe. We think that our portfolio was poorly structured to handle the current wave of volatility. Our investments were not prepared to react kindly to the market sell-off. Our short positions were not as highly weighted compared to our long positions, and we think if we were to do it again, we would give our short positions more of a chance to rebound during a sell-off. The timing on select names in our portfolio caused the majority of the damage as well, due to minimal diversification. We saw the consumer retail industry, the shorts in that area, really hurt our portfolio. We think that if we were to do it again, we would obviously diversify within the consumer and retail space if we did find names that we think were not so much value plays, but something that we would want to short. So we think that we would diversify maybe down from that 5% initial investment range to maybe 2.5% or even lower, just to make sure that we are well positioned in case maybe the consumer retail market is down in general, but some of those individual picks that performed better and hurt our portfolio in the long run wouldn't cause as much damage.